Hey gang, thanks for coming to the call tonight. Before we get started, the call will last about an hour. So it'll last an hour tonight, an hour tomorrow night, and the last class, or the third class, will last about an hour and a half. So be prepared for that. But tonight will be about an hour long. We'll try to get this wrapped up in an hour. But before we get started, let's talk about myself. Who am I? You're probably wondering that yourself, and I know a lot of folks are. So let's talk about who is John Michael Lush. Well, I focus on the four F's: faith, family, finances, and freedom. And in fact, in that specific order, they come in that order for myself. What I am is a recovering mortgage banker. Now, that's not to say that I'm not currently a mortgage banker. I am actually. I stay in the trenches. I like to know what's going on, what law changes are happening, and quite frankly, some folks don't qualify for a home equity line of credit, and some, during the consultative process, you say, you know what, it sounds too good to be true. I don't want to investigate this more. I don't want to know the math, and I just want to continue living inside my box and continue to do a mortgage. So we still do mortgages for those. We'd rather they get them from us as opposed to someone who's going to rip them off. So I call it a recovering mortgage banker. Been doing it for 14 years at various levels. I started off as a loan officer right out of college. If you want to investigate myself, who I've worked for, what my track record is, you can go to the NMLS Consumer Access. Just Google that and put in NMLS number 168206. So 168206. Currently, I am Senior Vice President of the Federal Savings Bank. I am a certified VA loan specialist, and I despise mortgages, ironically, and ultimately non-leveraged debt. I'm also a student of the infinite banking concepts. In my personal life, I'm a proud husband of 5 years to a smoking hot wife, proud father of 2 boys, Wyatt and Sawyer, and I've got another baby boy on the way now. He'll be here in a couple months. I was a former college basketball player. My basketball career was cut short with heart failure. I was born and raised in Fairview, Tennessee, which is a small town west of Nashville. I love farming and will eventually retire on a farm in the near future. I'm a huge fan of mixed martial arts, but too dang old and out of shape to participate. And you will hear about my faith often, and I will share the gospel. So be prepared. I'll make no apologies about that. Why should you listen to me? We only work with clients we know we can get results for. So if you're a part of this class, you already had a consultative process with us where we talked to you about qualifications for this course, what it took to qualify to learn our course. And we only want to work with clients that we are going to see huge transformation. So if you are a client and you're on this call, congratulations, because all this is math. It is not magic. If we choose to work with you, you will get results guaranteed because it's mathematically impossible not to. It took me 4 years to perfect this formula. So I didn't break the code on this. This is something like you that probably sounded too good to be true. And I said, you know what? I don't want to be paying on a mortgage for 30 years. So I investigated it. And being a mortgage insider, it took me 4 years to understand this. So you're going to be able to get my cheat sheet and save yourself years and thousands of dollars. Don't worry, we're not offering a loan, but instead a solution to the loan itself. So during this course, you're not being solicited for a loan. This is merely education. So you're going to get an education that at the end of this, you're going to look at financing real estate in a whole different perspective, and not just real estate. Really, we get into a lot of different areas. And we have 100% client satisfaction. So after this education, again, you're never going to view finances the same way, and actually you're going to view it in a positive way moving forward. The average savings per client within the first 6 months of taking our course is $8,314. Now, obviously, that's the average. Some are lower, some are higher. Actually, many are higher. If your financial situation, everybody's situation is a little bit unique. So if your mortgage payments and debts right now are higher than the average person, well, then you're going to actually see more savings. If you're more cash flow positive than the average person, then you're going to see more savings. But our average client saves $8,314 in the first 6 months alone. Some of our best clients are actually mortgage experts. Yes, you can read that again. Some of the best clients that we have are actually mortgage experts. We review this every week, what our professions are as far as the clients coming in to kind of understand from a marketing perspective who we need to be targeting. And apparently we need to be targeting mortgage experts. They're insiders. They understand the math and the process. So once they hear the truth, now they may not know it on the front end, but after speaking to us and having a consultation, they tend to sign up very quickly and become clients. So think about that. If the experts don't want a mortgage, then why in the world would you? Well, the answer is you wouldn't, just as they wouldn't. So where can you find us? Where can you find Replace Your Mortgage? Well, obviously, we've got our website, www.replaceyourmortgage.com. We have a YouTube channel. Now, if you're a client, you're watching this, we're going to get this emailed over to you, so you don't have to get out a pen and piece of paper and jot down all these weird-looking letters and numbers here. But we've got a YouTube channel where we've got lots of videos up there for you to explore. Facebook page, so we've got a fan page, but we also have a secret Facebook group. This is for clients that have paid and become a clients of ours, where we provide ongoing support. So in that Facebook group, they can pose questions or talk to this bank, this credit union was asked this question or this disclosure. Or in this scenario, we're looking at staring down the barrel of having to get a new car because ours is about to break down. What should we do? So we've got a secret Facebook group where clients can pose questions, and we will continue to provide ongoing support. So we'll get these links out to you in email so that you can find us when you need to. Now, deliverables. What can you expect from us in this course? Well, you're going to get the best education available on this topic. The education is going to save you tons of money guaranteed. Again, it's math. You've already taken out the debt, if you're refinancing or if you're looking to buy, you're already thinking about debt unless you're going to pay cash for something. So the difference between what you're going to pay with traditional financing and what you would with our strategy is math. It's already predetermined. So we can actually guarantee the results and guarantee the savings. Now, the class is going to be at 8 p.m. Central Standard Time on Monday, Tuesday, and Wednesday nights. And the link for each night's course will be emailed at 7 p.m. Central Standard Time each night. And it's going to be a different link each night. So don't use the previous night's link thinking you're on the course. It's not. Each night, check your emails. You'll get an email saying, click on this link to access the course. If class is postponed for whatever reason, the only time we did that was Christmas, but if it is postponed for whatever reason, you'll be advised in advance via email. Clients can participate in other courses offered on different weeks if you need a refresher or if you can't make the specified time slots for free. So again, once you become a client, you're a client for life. So if you sign up for this week's course and for whatever reason you can't access this week's course, well, then you'll be able to get on next week's course as well. So every week that we're offering this, just let us know and we'll send you the link so that you can access the course. Now, we're not going to hunt you down to get you to participate. This course requires action, and non-action takers will need to get off at the nearest exit. And we still love you, though, but we want to work with folks that are actually going to perform this. We want to see true life-changing transformations. So if you're not an action taker and you know that about yourself, then disregard this and just go ahead and log off. Okay, with all that being said, we're going to start tonight's course. So what we're going to start with is what I call the bank scam. May sound a little harsh. It's not quite a scam. They're doing something that's perfectly legal. In fact, in little subtle ways, they're actually telling you that they're ripping you off. But I like to refer to it as a scam. All right, so understanding the banking scam. Let's talk with the main components here. The banks lend money to customers at a higher rate than they pay to depositors or than they borrow it. The difference is known as margin or turn, and it's kept by the bank. So key components, for example, if a bank pays 1% interest on deposits, they may charge 6% interest on loans. However, the average savings account rate in the United States currently lingers around 0.17%, according to Go Banking Rate data. So moving forward, instead of me having to say 0.17%, let's just say 0, because that's next to nothing anyways. They also charge customers fees for services to do with managing the accounts and earn money from bank charges levied on overdrafts which exceed agreed limits. So basically, you're giving your money to the bank and they charge you fees to keep it and only give you 0% and then lend it back to you in the form of loans at a much higher rate of return. Doesn't sound like such a good deal. Now, this is inflation rates. This is the average inflation rate since 1913 all the way till 2013. So I know that we're in 2016, but in 2013, the long-term average is 3.22%. Right now, we're seeing very low inflation rates, around 1.4 to 1.6%. But historically, the average is 3.22%. Now, why do we talk about inflation rates? Well, inflation is a cost of goods, and the cost of goods moving up. So if you're giving your money to park in a bank, and they're giving you essentially 0%, but then you have inflation rates, well, then your money's moving backwards, right? Well, if your money's moving backwards by sitting in a checking account or a bank account, it's now considered a liability. Why is it a liability? Well, you're depositing your money into the bank at roughly 0%. Average historical inflation is 3.22%, so your money's going backwards. So outside of your mortgage that you're also getting from who? You guessed it, the bank, you're losing roughly 3%. Now, when you calculate the interest that you're paying on your mortgage, well, then you're losing that much more. So what the banking system is designed to do is for you to segregate your income. And what it means is you can't get 100% income utilization, which we'll talk about here in a little bit. But the bank forces you to get closed-end mortgages, which means money can only go in and cannot come out. So you have to leave money behind, and that's called a segregation of income. So before we get into that, let's talk about some home ownership statistics. Home ownership rate is 64.5%, which is the lowest since 1995. Only 29.3% of homeowners own their home free and clear, according to Zillow. So less than 1/3 of homeowners actually own that home free and clear. Average mortgage debt is $147,000. Average credit card debt is $15,000. Average student loan debt is $30,000, $31,000. Average auto debt is $31,000. Average household income is about $51,000. 25% of Americans have no savings. 50% of Americans have no money in retirement. And the number one reason for divorce in America is debt. So why does this matter to you? Why should it matter to Americans in general? Well, we have to think about what's causing these problems. Why do we have so much debt? Why do we have such low home ownership and such low percentage of homeowners who actually own their home free and clear? And why don't we have any savings or money in retirement? Not the only reason, but a primary reason is the way that we finance the largest asset, or could be the largest liability. It depends on how you finance it. Will determine whether or not your home is an asset or a liability. How are we financing that? We're financing it in actually the worst way possible on a 30-year mortgage. Americans buy payments they can afford on a monthly basis instead of total purchase price we can afford. See, that's been a mindset shift over the last several decades, where instead of Americans looking at what the total price of a home is, they're actually looking at payment and how much down. That's what we focus on. How much is the monthly payment? How much down? So if I told you that the monthly payment was $1,250 and you didn't have any money down, it's a $250,000 house, and I said, okay, well, you can have a $1,250 payment and no money down. It's $450,000 house. Which one would you choose? Well, you choose $450 because it's a bigger house. So we don't focus on the total price. We focus on the short-term monthly budget. So how much monthly and how much down? And we have to change that, because the longer that you have a mortgage payment, the less you can afford other items. For example, school, cars, vacation, etc. Items that also get borrowed via credit cards and car loans and student loans. So once we've maximized our monthly budget and we can't afford anything else, we go out and get even more debt, credit cards and student loans, etc. So we don't own our homes. We just rent them from the bank at an exorbitant cost. And we chase low rates and refinances and purchases rather than total interest paid. I dealt with that for 14 years. Folks calling me up and they're 5-6 years into their mortgage, and guess what? Rates dipped a little bit. So they want to refinance and get that lower rate, right? And what are they asking for? They're asking for a 30-year term. And here I am trying to fight that battle and say, no, you don't want a 30-year term. Let's go to a 20 or 15. But ultimately, they still want the 30. Why is that? Because it's got a lower payment. And although through, sometimes hours of consultation and showing them the math, that although it's a lower interest rate and a lower payment, they're costing themselves thousands, if not tens of thousands or hundreds of thousands of dollars, and they'll never be able to recoup what they just cost themselves. And on top of that, you have closing costs. Closing costs range from 2 to 5% of your loan. The lower the rate, the higher the closing costs. The higher the rate, the lower the closing costs. Either way, the bank still wins. So let me back up and explain that. The bank may offer a low rate, but they're going to have closing costs associated with it. You see this time and time again. But you also hear about banks and mortgage companies that say we have a no closing cost loan. Well, really what they're doing is they're marking up that interest rate and creating additional margin and profit, and they're paying the closing costs on your behalf. It's actually the more expensive way to finance a mortgage is to have a no closing cost loan. So I get it all the time. Customers say, beating their chest with pride, I've got this no closing cost loan. What you just signed up for is for the bank to charge you a higher rate than what you actually qualified for. So now you're going to pay 2 to 3 times the amount on those closing costs rather than had you just paid them on the front end or financed them in with a lower interest rate. Now you got a higher rate and a higher payment for the life of that loan. Doesn't make sense. And again, closing costs just further increases the principal amount owed, and the more that you owe over the longer period of time, the more you pay back to who? You guessed it, the bank. They're going to win. They're always going to maintain control. So what you're looking at here is a graph. This is an axis of when your payments actually start affecting more principal than interest. And on a 30-year mortgage, you're going to pay more interest than principal for 18 and a half years, or 222 months. If that didn't make you sick enough, for the first 5 years of a 30-year mortgage, it's predominantly interest only. Now, it's not interest only, but it's predominantly interest only, meaning the majority of your payments is going towards interest rather than principal. Now, that's by design because the average borrower refinances or sells every 3 to 5 years, meaning the bank made 90% profit at payoff. I get it a lot of times when folks are refinancing and they're looking at their mortgage statement and thinking that that's their true balance. But when they go to refinance, they're like, well, hold up. The bank charged me $3 or $4 grand more to refinance. Well, that's not a payoff. Your mortgage statement is not a payoff. They're actually going to charge you per diem, so additional fees on the back end of the loan as well. Now, biweekly payments, that does help. If you are going to stay on a mortgage, which obviously I would not encourage or recommend, but if you were to stay on a mortgage, the least you could do is do biweekly payments. What biweekly payments is, let's say you have a $1,000 mortgage payment. You're going to cut that in half. So you're going to pay $500. You're going to pay $500 every 2 weeks. Well, if you pay every 2 weeks, you've got 26 payments, right? Well, 26 half payments is equal to 13 full payments. So essentially, you're making one full payment a year. And by doing so, you can knock a 30-year mortgage term down to a 25 or 23-year mortgage term. So it does save you quite a bit of money. 15-year mortgage is going to drastically increase your monthly payments, allowing a little flexibility in your finances, but it will no doubt reduce the amount of interest that you pay by a substantial difference. But either way, it doesn't matter if you do a 15 or biweekly or 30, the bank is going to dictate the allocation of your payments to either principal or interest. And again, they're going to maintain control. So let's talk about the government role in mortgage industry. 99.3% of all mortgages are backed by 3 major government enterprises: Freddie Mac, Fannie Mae, and Ginnie Mae. Ginnie Mae is your FHA, VA, USDA programs. So essentially, if you have a mortgage, there's a 99.3% chance that it's insured or backed by the federal government. And that's how the majority of Americans did. And so you're not alone. You don't know what you don't know. So if you feel like at this point, oh my goodness, I made a mistake, so did a lot of folks. We're just taking it one customer at a time. Now, these government enterprises set the standards and guidelines that lenders and banks have to abide by. So it made banks and lenders roughly the same. So if prior to 2008, you may have one bank down the street that would deny you, but there's somebody in this country, maybe even the bank across the street, would say, no problem, we'll give you a loan. Well, now the guidelines are set by the government. So VA has the same guidelines regardless of the lender. FHA has the same guidelines regardless of the lender. Same thing with Fannie and Freddie. Now, some banks and lenders may have additional guidelines above and beyond what the government requires, called overlays, but no one can have less. So it created this enormous uniformity of lenders and banks across the nation. Now, regulations, one thing that I think was great about change in 2008 was it made the compensation plans for lenders and banks uniform as well. See, loan officers used to get paid based on what they could sell you. So if you qualified for 4%, but I could sell you 4.5%, well, I could make more money. See, that doesn't happen anymore. Now it's based on the percentage of the loan volume. And I think they could take this a little bit further to make it more consumer friendly. But now it's a flat percentage of the volume of the loan rather than the interest rate of the loan. And what that did was it obviously you had external factors that brought down interest rates, but this also had a major stake in bringing down interest rates as well and making them more competitive. Because think about it from a loan officer or banker standpoint. If you qualify for 4%, I'm going to give you 4% or even try to get you lower. I'm going to put my best foot forward because my compensation doesn't change if I give you 4% or 4.5%. So I might as well give you the lowest rate that I have. That's the bank's money that they have to worry about. My compensation is the same no matter what. So again, I'm going to take the path of least resistance for a sale and give you my best interest rate right up front. Something that should have been happening for decades but just wasn't. So The other banks are obviously doing the same thing. So they're just trying to leapfrog over each other, and it made these very tight margins on mortgages. So the profit on mortgages shrank dramatically after 2008 because, again, the compensation plan is not tied to interest rate or any other component of the loan. It's only tied to the volume of the loan. And I'll get into later of why they could take this a step further and make it even more consumer friendly. But so far, that was one of the things that I really liked about the regulation change in 2008. Bottom line, shopping around is not nearly as beneficial as it used to be. The variances between lenders is very small. Service is the only difference from one lender or bank to the next. And what I mean by service, working with someone who knows the programs and is going to put you in the best program given your qualifications, needs, and wants. Now, on top of that, deliver that program in a timely fashion. Not something that's going to take 3-4 months, but something that's going to take several weeks. Mortgage process is a lengthy process and gets longer. To be honest with you, the more the government meddles in it, it does get longer. But that doesn't necessarily mean it's bad for you, but you want somebody who can deliver in a timely fashion and not take months to do so. Okay, what's another huge waste of money? Mortgage insurance. Mortgage insurance is a complete waste of money, and no one should be paying mortgage insurance, even with folks that get a mortgage, because there's always been an opportunity to do what's called a piggyback loan. And you remember in a couple slides ago, I mentioned that where the government could take this a little bit further, where loan officers and bankers are paid off a percentage of the loan and not on the interest rate. Well, here's where they could take it a lot further. There's really not been a reason for folks to pay mortgage insurance. If you're putting 5% down, 10% down, whatever, there's no need. You can always do what's called a piggyback loan. So if you did a 80% mortgage and let's say 10 or 15% home equity line of credit, well, you don't have to have mortgage insurance. But since the loan officers and bankers are paid on a percentage of the loan amount, and it's not just that, it's also they don't know what they don't know, but since they're getting paid on the loan amount, well, what's a bigger commission? A 95% financing loan or an 80% financing loan? Because a HELOC, they just don't get paid for. And we'll also get into that here in a little bit too. So that's where I think they could take it a little bit further. But mortgage insurance is a complete waste of money. It's issued to protect the mortgage company in the event that you default. It does not protect you as the consumer. There's no benefit to you as a consumer to pay mortgage insurance. And believe it or not, even today, I get folks that'll call and pound their chest with pride and say, I don't have to worry about that. I pay mortgage insurance, as if it's some benefit to them. Again, zero benefit to you as a consumer. It's required if you're putting down less than 20% when buying a home, or if you're refinancing, you got less than 20% equity on any one loan. So that was the key on the piggyback scenario. It's not the same as mortgage protection insurance, which protects the heirs if you die. This is a totally separate policy, or that's a totally separate policy and an additional expense. Not to mention another one that I don't recommend. FHA, USDA, and VA also have upfront mortgage insurance fees. FHA is 1.75%. USDA changed there recently from 2% to now 2.75%. And VA has a funding fee as high as 3.3%. So let's take a $200,000 loan. Say you're going VA financing. Well, you're actually not taking out a $200,000 loan. You're taking out a $206,600 loan. So if you're doing 100% financing with VA or USDA, you're already upside down in your home. So let's look at it from this perspective, because I always like to look at things from a lost opportunity cost perspective. If my money is going to somebody else for something I don't get a benefit for, then what opportunity am I missing out where it could have been somewhere else? So typically mortgage insurance is 50 to 100 basis points, and I talk like a mortgage banker, so that's 0.5% to 1% of the total loan amount, and sometimes more. Average home price is $230,000 according to National Association of Realtors. So mortgage insurance is roughly $200 a month. That's a car payment. And it also may not be tax deductible. There's a threshold, for example, married couples filing separately of $55,000. So not only are you paying it, but there's situations in which it may not even be tax deductible. So you're giving your money away. And here's the lost opportunity cost scenario. It could take you years to reach an equity position of 20%. Instead, take that $200 a month, invest it in the market, earning 8% annual rate of return, and it adds up to $37,000 in 10 years. So imagine that. You could either have $37,000 in 10 years sitting in an account that you own, or have spent $37,000 to the government, essentially. So that's a difference. It's not a difference of $37,000. It's a swing of $74,000, a major difference. So let's break down one example of those, and let's break down FHA mortgage insurance. So let's say you got a loan amount of $200,000 at 4% interest rate on a 30-year term. Your upfront mortgage insurance premium, which is the amount that gets financed on top of the loan amount, is 1.75%. So instead of financing $200,000, you're actually financing $203,500. Now the monthly mortgage insurance calculates like this. It's 85 basis points or 0.85%. And it's not of the original $200,000. It's on the new loan amount of $203,500. So that's $1,729.75 per year, or per month divided by 12 months is $144.14. So your total mortgage payment, excluding taxes and insurance for an FHA loan, is $1,115.68. And again, VA and USDA follow the same principles. VA doesn't have monthly mortgage insurance, but they also can have the most costly upfront mortgage insurance, but they don't have monthly. But USDA follows the exact same principle on this as far as the monthly portion. Now, something else to know about FHA. This changed last year about this time, so January 26th of 2015. FHA mortgage insurance used to fall off after roughly 5 years. So if you had 5 years of mortgage insurance, it would fall off, and then FHA is attractive because it's got more flexible guidelines and less money down. Well, now it never falls off. So you essentially have that mortgage insurance for the life of the loan for up to 30 years, which, have you heard of a mortgage that's over 30 years? So no. So in order to get off of FHA mortgage insurance, you actually have to refinance or sell in order to get off of FHA mortgage insurance. Okay, so what you're looking at now is the truth in lending disclosure. It's probably one of the more honest documents that you would have gotten from your bank or lender, but unfortunately it went away. As of October 3rd, 2015, this document no longer exists, along with the good faith estimate. And I'll get into what it was replaced by here in a second. But if you already have a mortgage prior to October 3rd, 2015, this is what you're familiar with. So I'll explain how the bank is letting you know that they're scamming you, so to speak, in lack of better words. So right here is your amount financed, $182,672.79. And you see you've got an interest rate of 4.625 and an APR of 4.965. But right here, that number is your finance charge. So that's how much interest you're going to be paying for this loan. So essentially, they're saying you're going to be buying one house for you, one for the bank. Here's the total of both houses put together. So $351,669. Doesn't sound like such a good deal anymore, does it? All right, so this is the loan estimate. This is what replaced the truth in lending disclosure and the good faith estimate. So in my opinion, I like this over the truth in lending and good faith estimate. It's more consumer friendly. It's definitely easier for loan officers. So as you can see here, you got a conventional loan, fixed rate, 30 years, 3.875, loan amount $162, $8,000 in closing costs, 16 grand to the table is what's required. So pretty simple, right? Now we can tell it's also a conventional loan because it's telling you that for the first 7 years, this is what your payment is with mortgage insurance, which again is a waste of money, and the next 23 years without mortgage insurance, what your payment would be. So let's go to page 2. This is probably the only area where I'm going to defend the banks and lenders, because when you saw that $8,000, which you see right here in total closing costs, who are you blaming? You're pointing the finger at the bank or the lender. Well, in fact, the lender only makes up a very small portion of that. So what you see here is $1,802. That's actually what the lender can control. Now, you got $405 for origination, application fee $300, underwriting fee $1,097, an application fee. So that kind of really irks me. By you applying for a loan and getting a loan through the bank or lender, you're going to make that loan officer and that bank thousands of dollars. And for that opportunity, they're going to only charge you $300 to apply. That doesn't make sense to me. Underwriting fee $1,097. Your loan officer or a banker may say, well, we have to charge an underwriting fee because that's what pays for the underwriter. I can guarantee you there isn't an underwriter in this country that makes over $1,000 per file that they underwrite. They underwrite about 40 to 60 files per month. If that was the case, I would have been an underwriter for a couple of years and I would have been retired by now and you wouldn't be hearing my voice today. But nonetheless, $1,802 is all the lender controls on this transaction. These fees, they cannot make money on. These fees are just the fees that actually was the cost of doing business. So the appraisal fee actually had to cost $405. The credit report actually had to cost $30. They cannot mark these fees up to make money on it. It's illegal. Services you can shop for, so $3,200. So now we're starting to get into some bigger fees. Well, that's title fees. The title company charges that, not the mortgage company. Then you've got escrows for property taxes and homeowners insurance, which you don't want to escrow, and we'll get into that at a later date. But you definitely do not want to escrow on your new home equity line of credit. So in a nutshell, out of the $8,054, $1,802 of it was charged by the lender. But here's where it gets really interesting. This is page 3 of the loan estimate. And here's where they're telling you in 5 years, you're going to pay roughly $72,000, $73,000 towards the mortgage in 5 years. But only $15,000 of it is going to reduce the principal. That doesn't sound so good, does it? So again, out of $72,000, only $15,000 of it is going to reduce the principal. Then you've got the APR, 4.274%, because APR is taking into account the closing costs of mortgage insurance. But here's where folks are starting to wisen up a little bit. And this is why I like the fact that they instituted the loan estimate, because for 4 years, I've been asking folks, what is your rate of interest? And when I ask someone what their rate of interest is, they would regurgitate what their interest rate is on their mortgage. And I would say, no, that's your interest rate. That only dictates your payment. What I'd like to know is what your rate of interest is. And they couldn't tell me. They didn't know. It was a trick question. I knew I was kind of pinning them in the corner. But what I was trying to get the consumer to understand is the interest rate only dictates the payment. It doesn't dictate how much interest they pay. Rate of interest was the total interest that they would pay for that mortgage. So I called it rate of interest. The government calls it total interest percentage or TIP. But on a conventional loan, you're looking at 70%. So ask yourself this. Banker calls you up and says, I got this beautiful loan. I think it's the right one for you. It's got the payment you want, closing costs you want. And you say, okay, well, what's the interest? And they say 70%. You're probably going to hang up on them, right? Wrong. This is what we've been doing for decades. And we should have been hanging up on them, and we didn't. So let's talk about the differences between a traditional mortgage and a home equity line of credit. So a traditional mortgage, you cannot utilize 100% of your income. And what I mean by that is if you put 100% of your income into your mortgage, you can't get any money back for bills. It's trapped. It's in the bank's treasure chest. So by design, a traditional mortgage is closed in. So money can only go in and it cannot come out. And the reason why that's by design is it doesn't allow you to get 100% utilization of your income. It causes you to segregate your income. So you have to leave money behind. So if you're only putting a little bit of money into your mortgage, that means you're going to pay on it for a long period of time. And you're going to pay additional interest to who? The bank. So the longer you're in debt, the more interest you pay, the more the banks profit from the interest. Now, when you leave the money behind, where are you leaving it? Into a checking account. For who to profit on since you're getting 0%? The bank. So again, this is completely by design. It's forcing you to segregate your income, because when you segregate your income, you cannot get 100% income utilization, which means you stay in debt longer, and they get to use your leftover income to manifest dollars out of thin air and lend out 10 times what you deposited. So it's actually something to envy to a certain degree, because it's ingenious. No flexibility. Again, money in and money cannot come out, and your contract payment is fixed. So it doesn't matter what your balance is, your payment is going to be the same for 30 years. Now let's compare that with home equity line of credit. You can get 100% income utilization, because now, since it's open-ended, money can go in and out freely. You can confidently put all of your money into it, just like a checking account, because that's how you're going to treat your home equity line of credit, is just like a checking account. So you're going to put 100% of your resources and revenue into your home equity line of credit, and the payment varies. And the reason why it varies is it's based on that day's balance. It's a simple interest loan. So as the balance decreases that day, well, guess what? The next day, you're going to be paying less interest on the very next day. So the payment is going to reduce with it, just like a credit card. So you may have a higher minimum payment, but as you pay towards the credit card, guess what happens? The minimum payment decreases. Same thing with a home equity line of credit. You're only paying interest on that day's balance. So right there is where you know the interest rate is not the villain, it's balance. Something has to feed the villain. So balance is the actual villain. And the lower the balance is, the less interest you'll pay regardless of the interest rate for the most part. And again, it's open-ended, so money can move in and out freely. And what you're seeing here is a $250,000 mortgage. All right, you've got an interest rate of 3.25%. Let's say interest rates, they chose a variable rate mortgage, which, believe it or not, there are fixed rate mortgages. Actually better than fixed. They're flexible fixed, is what I like to call them, because if interest rates go down, you can actually unlock them and lock in a lower rate. But that's neither here nor there. Let's talk about the most common type of HELOC, which is a variable, where interest rates can go up or down. So interest rates have been very steady for 10 years, but let's assume the interest rates are going to go up and continue to go up every single year that you have it. And you start off with 3.25, and it's going to go up 0.5% every single year. Well, let's say this household has $6,000 in net monthly income, and then they've got $4,000 of monthly expenses. And again, that's outside of the home equity line of credit payment because that's already built into this number here, $6,000. So this calculation is already taking that out. So you're going to be pulling an additional $4,000 out of the home equity line of credit to pay for bills. Well, you'll have it paid off in 160 months, which is 13 years and 4 months. So this family at $250,000 mortgage, bringing in $6,000, having monthly expenses of $4,000. If they had a mortgage, they're about living paycheck to paycheck. They may have $500 or $600 at the end of each month left over, but that's about it. They're pretty much living paycheck to paycheck. It would take them 30 years. If income didn't go up and expenses never went down, it would take them 30 years to pay off that mortgage. But with a home equity line of credit, 13 years and 4 months. So again, home equity line of credit is complete flexibility. Money can go in and out freely 24/7, 365. So I just had that question. I actually get it every day, but I had it again today. What happens when it's time to pay our bills or we want to go on a vacation? Well, you just take money out of your home equity line of credit, just like it was a checking account. It's really that simple. Okay, the difference in interest rates. Traditional mortgage rates tend to be fixed for 30 years with the exception of adjustable rate mortgages, which are ARMs. Not many folks are doing ARMs these days because, quite frankly, the rates aren't that much lower than fixed. So what's the point? They end up going with adjustable rate mortgage. HELOCs are based on prime rate, which right now is 3.5%. It has been decreasing or stayed the same at 3.25 since 2008. It had been decreasing for about 10 years. And in December of 2015 is when the feds finally said, you know what, we're going to move it up a quarter. So it went to 3.5%. LIBOR, that changes daily, but right now it's at 0.35%. So HELOCs can be based on prime or LIBOR. However, prime rate and LIBOR tend to be variable and can change at any time. Many banks offer fixed rate HELOCs, but you'll pay a higher rate to get that security. So me and my family, the math doesn't make sense for us to get a fixed rate HELOC. And what I mean by having to pay for that security is, we got in at 3.25%. Actually, we had an introductory offer of 1.99. And then after the introductory offer, it was 3.25. However, if we'd have got a fixed rate HELOC, we'd have been paying about 3.75 or 4%. So since we're interest rate immune, meaning we're reducing the principal faster than the rise of interest rates, we choose to stay on a variable. I don't want to pay that additional margin that the bank is going to make in interest when I don't feel like prime is going to get there faster than I can pay it off. So that's what we chose to do. But you can, if you're absolutely risk adverse and you think the sky is falling and winter rate's going to skyrocket again like they did in 1982, a long time ago. But let's just say if that happened again, you can absolutely offer to get a fixed rate HELOC. And what's very cool about a fixed rate HELOC, many of these banks offer this mechanism, is for $95. Each bank has different fees, but one of the more popular ones is $95. You can unlock the rate and lock it in at a lower rate if rates come down. You can do that 3 to 5 times over the life of that loan. Wouldn't it be cool if mortgages did that? But keep in mind, interest rate only dictates your payment. Speed dictates how much interest you pay. Corporations live and die by the use of a line of credit, and they build empires around a line of credit. They get in and out of investments at their leisure. See, this isn't a new concept. Businesses have known this for decades, using a simple interest line of credit. Let's take an example. A chiropractor opens up a business. The bank is going to give him a business line of credit, and they're going to say, pay your bills and salaries out of your business line of credit and expenses, but we want you to set up a sweep account, which means you have to recycle your revenue back into the line of credit. I actually had a buddy who did this and paid his line of credit off extremely fast by using this method, and then turned around after the fact and say, hey, I'd like to buy a house. That's why I'm calling you. I'd like to get a mortgage. I said, absolutely not. You just used a business line of credit to illustrate exactly what I've been trying to teach for so many years. So just use a HELOC. And the light bulb finally went off. He's like, I didn't realize they were the same thing. Absolutely. All it is a simple interest line of credit. It's what a HELOC is. It's what a business line of credit is. Technically, that's what a credit card is. So you don't even have to have a HELOC to do this. You can actually use a credit card to do this, or a personal line of credit. So now that you've got a better understanding of your current system used to borrow, you can make drastic changes to swing the pendulum in your favor. And if you need more proof, look at your mortgage statement and you'll clearly see who's winning. You need to adopt a corporation mentality with your finances. If it's good enough for them, then it's good enough for you and your family. Sound too good to be true? It's not. It's just math, not magic. We get that a lot. This just sounds too good to be true. Why isn't more people doing this? Why doesn't anybody know about this? Why don't the banks tell us about this? Look, we'll get into why the banks don't tell you about this here in a little bit, but it's just math. That is something that you cannot debate and is not on trial. It's just math. It does work. And it doesn't take a long time to see the results. In fact, you're going to see drastic results in the first 30 days. Again, all you have to do is take a look at your mortgage balance as proof. So in the next lesson, here's what you're going to learn. Why the banks don't want you to know the secret, why your banker or loan officer doesn't know. That's probably another main reason why you don't know is your loan officer and banker doesn't know. So if they don't know, who's going to teach you? How to school your banker, forcing them to give you the best terms, how to avoid any closing costs, how to eliminate interest altogether using our strategy, and why APR, or annual percentage rate, is much different than interest rate. In this segment, we're going to talk about why banks don't want you to know. And what you'll see is the common denominators, they lose money. That's why they don't want you to know, for the most part, at least the upper echelon of the bankers. Now, your bank managers and so on, again, they don't know what they don't know. So if they haven't heard of this strategy or been taught this strategy, they're not going to be able to teach you. And why would they be taught this strategy by the bank? Think about it. If you put me in a bank branch where folks walk in and want to get a mortgage, well, guess what they walk out with? They walk out with a home equity line of credit. Well, it'd be too long. Probably by the end of the week, I would have to get another job because they would fire me. So in a nutshell, they're going to lose money. So let's talk about the different streams in which the banks are going to lose money. Number one is interest paid. Less interest paid equals less profit. Interest rate only dictates what your payment is. However, term or length of the mortgage dictates how much interest you will pay. This is a $250,000 mortgage. And just an illustration, even using mortgages, using their own product against them, I'm going to show you where speed makes more sense than anything. So on a 30-year mortgage at $250,000, you're going to pay $206,000 of interest. All right, and you're going to have a total paid of $456,000 for that house if you finance it for 30 years. Now, on a 15-year mortgage, you would think, okay, well, I'm cutting the term in half. I'd pay half the interest. No, it's actually less than half because, again, speed is the fix-all. So you're going to pay $94,000 or a total of $344,000 for that home. Now, this is where we as Americans have gotten away from the concept of total price versus what just fits in our monthly budget. Before, decades ago, we would look at this and say, there's no way we're paying $456,000 for the house. But now, what we look at is say, oh, it's $250,000 and the payments are $1,266. We can handle that. We'll take it. But here's real estate investing 101. If you took that house and bought that house at $250,000, at what price would you have to sell that in order to make a profit? I literally just had a realtor today, a very prominent realtor, tell me $270, because of closing costs and whatnot. I said, no, $456,020, really $17. But here's why. If they finance it for 30 years, you have to account for financing costs. That's real estate investing 101. That is a cost. So if you're going to buy a house for $250,000, you better hope that you can sell it. If you're going to finance it for 30 years on a 30-year mortgage, you better hope that someday you can sell it for $457,000 in order to make a profit, because that's reality. Same thing on a 15-year term. Will it appreciate by $300,000 to $344,000? I think that's inside the realm of being reasonable. How long it'll take? Maybe 15, maybe 20 years. I don't know. Every market is different, but that's still far better than doing a 30-year mortgage. But this was just to illustrate that term, or the length of having a debt, dictates how much interest you pay. And the faster you pay off your debts, the less interest you'll pay. But using the strategy, we're going to show you how to pay off your home in less than 10 years. Thus, the bank is going to lose massive profits. All right, so let's talk about income utilization. So we talked about it previously just for a few moments. So let's touch on it again. I want to give you a good visualization. I've got a thick tongue, so sorry for that. But of how this works. This is the current system today. So you're making money, right? And where do you put that money? Well, you put it into the bank. And there's a question mark over its head. It's like, why in the world am I putting it in the bank? Well, with the bank, you're earning 0.17%. But if you have inflation at 1.6%, your money's actually moving backwards at negative 1.43%. So that's why there's a question mark there. Should you put your money in the bank? Does it make sense to put your money in the bank since they're not giving you a rate of return and your money's going backwards? It now became a liability. And then we further compound the issue by getting a mortgage from who? Guess what? The bank. Probably the one that you put your money into. And then let's say they gave you a great interest rate of 3.01%. Well, now your money's moving backwards at negative 0.44% because all they did was just lend you your money back to you. Now it's time to pay your bills. Well, what if you put 100% of your income into a mortgage? Well, you couldn't get money back out to pay your bills, so therefore you're stuck. All right. Now let's look at a home equity line of credit. Money going in to your home equity line of credit. And again, they don't have closing costs for the most part. And some states will have some exorbitant title fees that they can't soak up all of that cost for you. So you may have to pay that out of your pocket or roll it into the HELOC. But they're not going to have lender fees. And in most states, you're not going to have closing costs. And then you've got these introductory offer periods. A lot of banks do this, 1.99, 2.99, whatever it is. Some of them are lower than that, 0.99. I actually have one customer who is planning on refinancing every year because what she's going to do is go from intro offer to intro offer. So she's always going to be at a much lower interest rate than everyone else. To me, that sounds like a headache, but you know what? It makes perfect sense. So you got your home equity line of credit. All of your money can go into it. When it's time to pay your bills, you just pull money out of your home equity line of credit to pay your bills. And what's left over is going to drive down your principal reduction, which means you're going to have more equity. So let's look at another example. Speed with the cash flow strategy. Same $250,000 example, 3.5% interest rate. The rate goes up 0.3% every year. Your payoff goal, you want to get this done in 10 years. So say you got a household income of $7,000, but after taxes, it's $5,650. Now, outside of the mortgage and all that, your other expenses, so gas, groceries, eating out, utilities, accounts for $3,000. So you got $2,650 now in cash flow positivity that you didn't have when you had a mortgage, because keep in mind the payment's going to be larger on a mortgage than it is on a home equity line of credit. But again, the interest is already getting soaked up into this number here, not this one. We don't have to add it here. So what does that mean for this couple or individual? $250,000 mortgage, they get paid off in 113 months. So that's 9 years and 5 months. So in less than 10 years, you can take $250,000, what would have been a mortgage for 30 years, and have it knocked out in a little over 9 years. And here's another calculator that you can get off of online from Vertex. And it's more complicated. You got to understand pivot tables and Excel spreadsheets. But I just wanted to illustrate that it's still the same. So as you can see here, we've got our $250,000, same terms here. This $2,650 was the difference between the $5,650 and the $3,000 expenses. So let's just say that's a fixed payment. It's actually more advantageous than this with a home equity line of credit, but I just wanted to keep it simple. That's the total interest paid, $42,820.61. Now, if you remember back on a previous example, the $250,000 mortgage, how much were you paying in interest? $206,000 in interest on a traditional mortgage, where it's only $42,000 for the home equity line of credit. No mortgage insurance. Hate to beat a dead horse. You shouldn't be killing horses to begin with, but let's just say you are. Traditional mortgage products require PMI when there is less than 20% equity in the home. A HELOC will eliminate private mortgage insurance or any type of mortgage insurance. Now, this is the same as the closing cost scenario that I mentioned, where some lenders will offer a no closing cost loan. Some lenders will advertise a no PMI loan if you're putting 5 or 10% down. Well, what they're doing, same example, they're just taking the P and hiding it under another shell, is they're bumping the rate up to account for that margin, that profit, and then they're going to take that margin and pay the premium on your behalf. So instead of paying the mortgage insurance short term that will eventually fall off, now all you've done is finance it in for the eternity of that loan. And loans don't last for eternity, but 30 years, most common one. So instead of just paying it, let's say for 7 years and it falling off, you've now chosen to have a higher rate and a higher payment for 30 years. So that doesn't make sense. That's actually the most costly way to finance mortgage insurance. The cheapest way, you guessed it, having a home equity line of credit, because they do not require mortgage insurance. And again, it's just an additional profit center for a lot of companies, but not a profit center for the consumer. And mortgage insurance protects the lender or the bank in the event you default on your mortgage. There is no benefit of PMI to you as the consumer, zero. And since the strategy does not use a traditional mortgage product, a HELOC is what's called a non-QM or non-qualified mortgage. It does not require any type of mortgage insurance. So again, I like to look at things from a mathematical standpoint. Assuming a $200,000 loan, you'd pay about $166 a month in mortgage insurance for a product that has zero benefit to you. And again, that's a car payment, that's a family cell phone bill, utilities, etc. So that money could be better served elsewhere, and that's what we call lost opportunity cost, as opposed to going to the bank with zero benefit to you. So let's follow the money from this profit center for mortgage insurance, because again, this is another area in which they lose money. When FHA has 1.75% upfront MI and 0.85% monthly. So if you had a $200,000 loan, you're going to pay $3,500 for the upfront mortgage insurance and then $1,700 for the monthly. So you're looking at $5,200 right there. VA has a funding fee of 3.3%, so that's $6,600. USDA has a 2.75% guarantee fee and a 50 basis point monthly fee, so that's $5,500 plus $1,000. Now we're at $6,500. Conventional can be the cheapest if you have good credit, and that ranges anywhere from 54 basis points to 1.46%. So let's say somewhere in the middle at 90 basis points. On a $200,000 loan, that's $1,800 a year. A lot of wasted money regardless of the traditional mortgage scenario that you go. But if you went with a home equity line of credit, the number is zero. They just don't have any. Now, the other profit center where they lose money, closing costs. Low closing costs equals less profit. And this is an example of what closing costs was in 2014 average by state. Now, the U.S. average was right here in the middle, and what that number was $2,525. But if you read the fine print, now that's just lender fees. That is not total closing costs. That's just what the lender is responsible for, was $2,525. But again, the fine print from bankrate.com says this is a $200,000 loan with 20% down and a good FICO. So for folks not putting 20% down, what can you assume? Closing costs are going to be higher. For folks that don't have a good FICO, what can you assume? Closing costs are going to be higher. And your assumption would be accurate. Lenders and banks make additional profits on junk fees. And this is what internally we would, if I called a different bank and said, hey, what are your junk fees? They're going to know exactly what I'm talking about. They're going to riddle off these fees. They're processing fees, underwriting fees, application fees, origination points, discount points, etc. It's additional profit. They are 100% negotiable. The banks make plenty of profit on the margin of the interest rate that they sold you. So why are they charging these fees? To make more money. It just became the industry norm to charge these fees. HELOCs typically don't have lender fees. They only have fees the only fees that you can expect are the title and recording fees. And I say that for states like Florida, Maryland, New York, where it's not necessarily lender fees, it's title fees that are extremely expensive. So the lender can't pay the title company all their fees. So they'll give you a credit for that, and then what's left over you are responsible for. But nonetheless, it is far cheaper to do a home equity line of credit on the closing cost side than it is a traditional mortgage. Therefore, they lose massive profit. So you save $2,525 on average up front. Now, if you're saving that, it's costing them that. Again, your savings is their cost. Another reason, and very common reason, even loan officers don't know. We just had a survey to take a look at what our clients look like by industry and profession. And wouldn't you know it, our best clients are loan officers. Why? Because when they hear the truth, they know it. And they know this. They're an insider, so they understand the math. So it clicks with them a lot sooner than it would your average consumer. Because again, this is what they're supposedly an expert at. But if the experts don't want a mortgage for themselves, why would you? It's kind of like Congress not wanting the Affordable Care Act. They want to be exempt from the Affordable Care Act. Why do they want to be exempt from the Affordable Care Act? I don't know, but I know I don't want it if they don't want it. Same thing here. So one of the more frustrating things about implementing the strategy is having to first educate the banker or loan officer. Just like you, most bankers and loan officers have never heard of this strategy, and they haven't been adequately trained. Purposely. The typical thought is you can only get a loan for a percentage of the equity that you have between the balance of your mortgage and home value. After all, it's called a home equity line of credit. I really wish they would take the equity portion out, because now that banks are offering 100% financing, there's one that does 125% financing, one that does 115%. That's absurd. I wouldn't send anyone to those banks for that product. I don't think that you should borrow more than the value of your home, or even 100%. I really like to see folks at 10% equity and below, and that way, you have maximum product and terms to be successful. But a home equity line of credit, you technically don't have to have equity, and it can be a first lien position loan. What first lien position means, it's your only loan, just like your mortgage is. So just like our website is called replaceyourmortgage.com, the reason why we called it that is a home equity line of credit can replace your existing mortgage. So you're not getting a loan on top of your current loan to pay off the old loan. You're actually getting a loan at closing that's going to be replacing your existing loan. So when I did mine, I had 10% equity in my house, and I had an FHA mortgage at the time of refinancing to a home equity line of credit. I only had 10%. So it took me some time, about 30 minutes, to educate the banker, and eventually said, look, let me just talk to your underwriter so I can explain it to her. And what you know, the underwriter's like, yes, you absolutely can do that, because they go up to 90% financing. So I said, I'm not looking to get a loan on top of my loan. I'm looking to pay off my existing mortgage with my home equity line of credit, just like any other refinance. Keep in mind, a HELOC is just another variation of a mortgage. It's just not commonly used this way. The most common way is as a second mortgage, or a second lien position for home improvements or cash out or debt consolidation. That's not what we're going to be using it for. We're going to use it to replace the existing mortgage. So I usually have to speak to 3 to 4 individuals at each bank in order to get the right answer, because again, they just don't know what they don't know. HELOCs don't pay well. Another reason the bankers and loan officers don't know or want you to know about this strategy is HELOCs don't pay well. In fact, in most cases, they don't pay at all. Typical compensation of loan officers or bankers for a HELOC is $250 to $750. That's for lenders and bankers who actually do get a compensation plan for home equity lines of credit. But again, most of them don't get any type of compensation at all for a home equity line of credit. But let's just say they did. A traditional mortgage, it usually pays 1% to 2% of the loan amount for a compensation. So if I were to do a $200,000 mortgage, I could make $4,000 in commission. And if I did a $200,000 home equity line of credit, the most I can make is $750. What do you think I'm incentivized to pay? Obviously, I'm incentivized to sell a mortgage. So think about it. If the bank makes less, they're going to pay less in commission. So that's why there's hardly ever commission on home equity lines of credit, and if there is, it's very small, because the banks aren't making much money on those. So if they're not making much money, they're not paying much money. So again, it's all about following the money. Why aren't they making much? Because you're not paying much. Well, if you're not paying much, who gets to keep that? You do. Banks sell traditional mortgages on the secondary market for additional profits, where a home equity line of credit tends to stay on the lender's portfolio line, thus creating less profit for the banks on the secondary market. So a HELOC is a bank program. They're lending their own money, which in a lot of cases, you'll see that there's a bigger appetite for risk for those customers that couldn't get a mortgage, could potentially get a home equity line of credit, because banks are lending their own money, so they kind of set their own policies for appetite and risk. Again, it's not in the bank's best interest that you know this secret. So pay attention to APR, annual percentage rate. Your loan officer's been telling you to only worry about the interest rate. It's easier to sell. It's the path of least resistance. It's the lowest number. However, APR is the true interest rate when accounting for closing costs. APR takes into consideration the closing costs, mortgage insurance, etc. For example, an FHA loan could have an interest rate of 3.5%, but an APR of 4.55% because of their upfront mortgage insurance premiums and their monthly mortgage insurance premiums. So an FHA loan, although advertised to have really low interest rates, which they do, can have the higher APR rates, even though the interest rates are lower. So it's because of all the costs. So a HELOC has an APR the same as its note rate because there's no closing costs and no mortgage insurance. So that's it for tonight. What we'll talk about in the next two classes is the typical terms of a home equity line of credit. Just like there are different variations of mortgages, some that are good for you, some that you qualify for, and some that you don't, and some that are bad for you, there are many different variations of home equity lines of credit, and we educate you on the different terms that you can expect from the proper home equity line of credit to execute this strategy most efficiently. First lien versus second lien position. Can you execute this in second lien position? Absolutely. So if you already have a home equity line of credit and you don't want to replace your mortgage, no pun intended, then you can use your second lien position home equity line of credit to eventually replace your first lien position mortgage without having to refinance. But we prefer first lien position home equity lines of credit over second lien position home equity lines of credit. The many types of HELOCs to avoid. There are many types of HELOCs to avoid. We've had actually two clients that said, you know what, we think we've heard enough and there's no need for us to pay a fee. We're just going to go get this loan on our own. And both of those ended up being clients. Why? Because they asked the bank to give them something, and sometimes you got to be prepared that what you ask for, you might get. And what the bank was giving them, because the bank wasn't educated, they weren't educated enough, the bank was giving them the wrong type of loan that would have compounded the problem that they already had with a traditional mortgage. So we're going to show you what types of HELOCs to avoid. Key components of a HELOC. What types of tax benefits does a HELOC have? And what's required to qualify and apply our strategy? You know, we like to see certain credit scores, 640 plus credit score, 10% equity, cash flow positivity, which means you've got low debt ratio or lower debt ratio. So good rule of thumb is if you qualify for a mortgage, you qualify for a home equity line of credit. Now, how to increase your cash flow without making more money? Believe it or not, there are ways to increase cash flow without increasing income or decreasing expenses. Now, for you CPAs out there and accountants, that's going to be a tough one to digest. But there's actually a way to increase your cash flow without making more money or decreasing your expenses. And when I explain to you what it is, it'll make you mad and happy at the same time. It'll make you mad because it's right there under your nose and has been for a long time. It's going to make you happy that you finally do know. But there's ways to actually increase cash flow, and that is the most important factor of doing this strategy. The more cash flow positive you are, the better you and faster you can pay off your home equity line of credit. How to achieve a 720 plus credit score and reduce the interest paid? Because yes, some of these banks still look at credit scores. A lot of them still look at credit scores. Believe it or not, a lot of them don't even go off of credit scores. They go off of their own algorithm. But in a nutshell, you do want to have good credit. You know, we've heard a famous radio financial guru tell people that having no credit scores for positive reasons, meaning you didn't have any debt, is as good as having an 800 credit score. That is not true. Everyone in the mortgage industry laughs at that, because what we do know is that if you don't have credit scores, is there a chance you can get a mortgage? Yes, there is a chance you can still get a mortgage. Your chances are slim, but you can still get a mortgage. And here's why we all laugh. If you do get that mortgage, you are going to be charged a much higher rate than those that did have a credit score and a sufficient credit score. So nothing could be further from the truth. So we do want you to have good credit scores. And if you don't have good credit scores, how do you achieve a great credit score? And again, it doesn't require great credit scores to get a home equity line of credit. And in a lot of cases, they're more lenient than mortgages are. And ultimately, how to automate our strategy and leverage this tool to build wealth. Home equity line of credit is something that you can use over and over again. So say the draw period is 15, 20 years, 10 years, whatever. Let's say you pay it off in 5 years. Well, a home paid off free and clear is no different than having a checking account. Your money's moving backwards. So why not leverage that home equity line of credit to invest, into something that's going to give you a better rate of return than negative 1.46%. So there's ways to do that, and we'll teach you that. So that's it for tonight. Thanks for tuning in. Wish you guys the best. Take care, and God bless.